PSAK 73 Lease Accounting Management System. In 2017, the Indonesian Financial Accounting Standards Board, DSAKIAI, issued PSAK 73 leases, and thereby started a new era of lease accounting for lessees. Whereas, under the previous guidance in PSAK 30 leases, a lessee had to make a distinction between a finance lease, on balance sheet, and an operating lease, off balance sheet. The new model requires the lessee to recognize almost all lease contracts on the balance sheet. The only optional exemptions are for certain short-term leases and leases of low-value assets. For lessees that have entered into contracts classified as operating leases under PSAK 30, this could have a huge impact on the financial statements. At first, the new standard will affect balance sheet and balance sheet related ratios, such as the debt/equity ratio. Aside from this, PSAK 73 will also influence the income statement, because an entity now has to recognize interest expense on lease liabilities, obligations to make lease payments, and depreciation on right-of-use assets that reflects the right to use the leased asset. As a result, for lease contracts previously classified as operating leases, the total amount of expenses at the beginning of the lease period will be higher than under PSAK 30. Another consequence of the changes in presentation is that EBIT and EBITDA will be higher for companies that have material operating leases. The new guidance will also change the cash flow statement. Lease payments that relate to contracts that have previously been classified as operating leases are no longer presented as operating cash flows in full. Only the part of the lease payments that reflects interest on the lease liability can be presented as an operating cash flow, depending on the entity's accounting policy regarding interest payments. Cash payments for the principal portion of the lease liability are classified within financing activities. Payments for short-term leases, leases of low-value assets and variable lease payments not included in the measurement of the lease liability remain presented within operating activities. Although accounting remains substantially the same for lessors, the changes made by the new standard are still relevant. In particular, lessors should be aware of the new guidance on the definition of a lease, subleases, and the accounting for sale and leaseback transactions. The changes in lessee accounting might also have an impact on lessors as lessees' needs and behaviors change and they enter into negotiations with their customers. PSAK 73 will apply to all lease contracts except for leases to explore for or use minerals, oil, natural gas, and similar non-regenerative resources. Leases of biological assets within the scope of PSAK 69, agriculture, held by lessees. Service concession arrangements within the scope of ISAK 16, service concession arrangements. Licenses of intellectual property granted by a lessor within the scope of PSAK 72. Revenue from contracts with customers, and rights held by a lessee under licensing agreements within the scope of PSAK 19. Intangible assets, for items such as motion picture films, video recordings, plays, manuscripts, patents, and copyrights. Aside from this, a lessee may choose to apply PSAK 73 to leases of intangible assets other than those mentioned above. Definition of a lease. PSAK 73 defines a lease as a contract, or part of a contract, that conveys the right to use an asset, the underlying asset, for a period of time in exchange for a consideration. At first sight, the definition looks straightforward. But in practice, it can be challenging to assess whether a contract conveys the right to use an asset or is, instead, a contract for a service that is provided using the asset. For example, an entity might want to transport a specified quantity of goods, in accordance with a stated timetable, for a period of 5 years from A to B by rail. To achieve this, it could either rent a number of rail cars or it could contract to buy the transport service from a freight carrier. In both cases, the goods will arrive at B, but the accounting might be quite different. Leases are different from service contracts. A lease provides a customer with the right to control the use of an asset. Whereas, in a service contract, the supplier retains control. PSAK 73 states that a contract contains a lease if there is an identified asset, and the contract conveys the right to control the use of the identified asset for a period of time in exchange for consideration. What is an identified asset? An asset can be identified either explicitly or implicitly. If explicitly, the asset is specified in the contract, for example, by a serial number or a similar identification marking. If implicitly, the asset is not mentioned in the contract, so the entity cannot identify the particular asset, but the supplier can fulfill the contract only by the use of a particular asset. In both cases there may be an identified asset. In any case, there is no identified asset if the supplier has a substantive right to substitute the asset. Substitution rights are substantive where the supplier has the practical ability to substitute an alternative asset, and would benefit economically from substituting the asset. The term benefit is interpreted broadly. For example, the fact that the supplier could deploy a pool of assets more efficiently, by substituting the leased asset from time to time, might create a sufficient benefit as long as there are no significant costs. It is important to note that significant is assessed with reference to the related benefits, that is, costs must be lower than benefits. It is not sufficient if the costs are low or not material to the entity as a whole. Significant costs could occur. In particular, if the underlying asset is tailored for use by the customer. For example, a leased aircraft might have specific interior and exterior specifications defined by the customer. In such a scenario, substituting the aircraft throughout the lease term could create significant costs that would discourage the supplier from doing so. The assessment whether a substitution right is substantive depends on the facts and circumstances at inception of the contract and does not take into account circumstances that are not considered likely to occur. A right to substitute an asset if it is not operating properly, or if there is a technical update required, does not prevent the contract from being dependent on an identified asset. The same is true for a supplier's right or obligation to substitute an underlying asset for any reason on or after a particular date or on the occurrence of a specified event because the supplier does not have the practical ability to substitute alternative assets throughout the period of use. If the customer cannot readily determine whether the supplier has a substantive substitution right, it is presumed that the right is not substantive, that is, that the contract depends on an identified asset. Lessee accounting. Initial recognition and measurement. The new lessee accounting model within PSAK 73 is the most important change to current guidance. Under PSAK 73, lessees will no longer distinguish between finance lease contracts, on balance sheet, and operating lease contracts, off balance sheet, but they are required to recognize a right of use asset and a corresponding lease liability for almost all lease contracts. This is based on the principle that, in economic terms, a lease contract is the acquisition of a right to use an underlying asset with the purchase price paid in installments. The effect of this approach is a substantial increase in the amount of recognized financial liabilities and assets for entities that have entered into significant lease contracts that are currently classified as operating leases. The lease liability is initially recognized at the commencement day and measured at an amount equal to the present value of the lease payments during the lease term that are not yet paid. The right of use asset is initially recognized at the commencement day and measured at cost, consisting of the amount of the initial measurement of the lease liability, plus any lease payments made to the lessor at or before the commencement date less any lease incentives received, the initial estimate of restoration costs and any initial direct costs incurred by the lessee. The provision for the restoration costs is recognized as a separate liability. Lease payment. Lease payments consist of the following components. Fixed payments, including in substance fixed payments, less any lease incentives receivable. Variable lease payments that depend on an index or a rate. Amounts expected to be payable by the lessee under residual value guarantees. The exercise price of a purchase option, if the lessee is reasonably certain to exercise that option, and payments of penalties for terminating the lease, if the lease term reflects the lessee exercising the option to terminate the lease. Discount rate. PSAK 73 distinguishes between three kinds of contingent payments, depending on the underlying variable and the probability that they actually result in payments. 1. Variable lease payments based on an index or a rate, variable lease payments based on an index or a rate, for example, linked to a consumer price index, a benchmark interest rate or a market rental rate, are part of the lease liability. From the perspective of the lessee, these payments are unavoidable, because any uncertainty relates only to the measurement of the liability but not to its existence. Variable lease payments based on an index or a rate are initially measured using the index or the rate at the commencement date, instead of forward rates or indices. This means that an entity does not forecast future changes of the index or rate. These changes are taken into account at the point in time in which lease payments change. The accounting for variable lease payments that depend on an index or a rate is illustrated in the example on page 32. 2. Variable lease payments based on any other variable, variable lease payments not based on an index or a rate are not part of the lease liability. These include payments linked to a lessee's performance derived from the underlying asset, such as payments of a specified percentage of sales made from a retail store or based on the output of a solar or a wind farm. Similarly, payments linked to the use of the underlying asset are excluded from the lease liability, such as payments if the lessee exceeds a specified mileage. Such payments are recognized in profit or loss in the period in which the event or condition that triggers those payments occurs. 3. In substance fixed payments, lease payments that, in form, contain variability but, in substance, are fixed are included in the lease liability. The standard states that a lease payment is in substance fixed if there is no genuine variability, for example, where payments must be made if the asset is proven to be capable of operating, or where payments must be made only if an event occurs that has no genuine possibility of not occurring. Furthermore, the existence of a choice for the lessee within a lease agreement can also result in an in-substance fixed payment. If, for example, the lessee has the choice either to extend the lease term or to purchase the underlying asset, the lowest cash outflow, that is, either the discounted lease payments throughout the extension period or the discounted purchase price, represents an in-substance fixed payment. In other words, the entity cannot argue that neither the extension option nor the purchase option will be exercised. If payments are initially structured as variable lease payments linked to the use of the underlying asset, but the variability will be resolved at a later point in time, those payments become in substance fixed payments when the variability is resolved. PSAK 30 does not contain any specific guidance on in substance fixed payments. However, the current practice already follows this approach. A residual value guarantee captures any kind of guarantee made to the lessor that the underlying asset will have a minimum value at the end of the lease term. The board indicated it believed that a residual value guarantee could be interpreted as an obligation to make payments based on variability in the market price for the underlying asset and is similar to variable lease payments based on an index or a rate. Initial direct costs. The standard defines initial direct costs as incremental costs that would not have been incurred if a lease had not been obtained. Such costs include commissions or some payments made to existing tenants to obtain the lease. All initial direct costs are included in the initial measurement of the right-of-use asset. Discount rate. The lessee uses as the discount rate the interest rate implicit in the lease. This is the rate of interest that causes the present value of a. lease payments and b. the unguaranteed residual value to equal the sum of I. the fair value of the underlying asset and 2. any initial direct costs of the lessor. Determining the interest rate implicit in the lease is a key judgment that can have a significant impact on an entity's financial statements. If this rate cannot be readily determined, the lessee should instead use its incremental borrowing rate. The incremental borrowing rate is defined as the rate of interest that a lessee would have to pay to borrow, over a similar term and with a similar security, the funds necessary to obtain an asset of a similar value to the cost of the right-of-use asset in a similar economic environment. Restoration costs. In many cases, the lessee is obliged to return the underlying to the lessor in a specific condition or to restore the site on which the underlying asset has been located. To reflect this obligation, the lessee recognizes a provision in accordance with PSAK 57, provisions, contingent liabilities and contingent assets. The initial carrying amount of the provision, if any, that is, the initial estimate of costs to be incurred, should be included in the initial measurement of the right-of-use asset. This corresponds to the accounting for restoration costs in PSAK 16 property, plant, and equipment. Any subsequent change in the measurement of the provision, due to a revised estimation of expected restoration costs, is accounted for as an adjustment of the right-of-use asset as required by ISAK 9. Changes in existing decommissioning, restoration and similar liabilities. PSAK 73 Lease Accounting Management System Modules. Administrator. User Properties. User Logs. App License. Master Data. Corporate. Vendor. Customer. Chart of account. Currency. Taxes. Cost center. Numbering. Item group. Unit. Bank interest rates. ICSU rates. Transactions. Lease data. Lease payment. Lease termination. Lease mutation. Lease closing. IBRP FA. Reports. Summary. Lease data. Lease payment. Lease termination. Lease mutation. Messaging. Inbox. Outbox. Draft. Your account. Change password. Change photo. Change language. Log history. We offer web-based software as services, SaaS, for your business solution. Nokiasoft, the software engineering services, believes, practices of the software engineering principles and best practices. Our adopted process framework, and our conviction on quality based our own software development experience, enables us to deliver the best to our customers. While software engineering has been around for decades, its adoption leading to business success through improved quality and predictability has been, by and large, a mirage. Software is essentially a construction in mind and, a collective one at that, with many stakeholders of varying interests and skills. Applying the engineering principles is more of continuous refinements of an adaptive process rather than adoption of a prescriptive process. Nokiasoft, with its wealth of acquired knowledge and more than a decade of experience, has specialized in transitioning itself and its customers into sound software engineering practices without undue documentation and technology overheads. We are the only IT consultancy management, design and development, software as services, SaaS, and cloud application solutions. SaaS app on cloud server. SaaS web-based application will be installed on data center cloud server. SaaS app on VPS server. SaaS web-based application will be installed on data center VPS server. SaaS app on dedicated server. SaaS web-based application will be installed on data center dedicated server. SaaS app in-house server. SaaS web-based application will be installed on your in-house server. Professional business application service provider. Software as service, SaaS, provider. Software as a service, SaaS, is a software distribution model in which a third-party provider hosts applications and makes them available to customers over the Internet. SaaS is one of three main categories of cloud computing, alongside infrastructure as a service, IaaS, and platform as a service, PaaS. VPS and dedicated application services. We also offer customers to run our web-based applications with a VPS that runs its own copy of an operating system, and customers may have super user level access to that operating system instance, so they can install multiple applications that runs on that OS. The system working 24 hours with high bandwidth internet connection. Agile software development. Agile software development is a conceptual framework for software engineering that promotes development iterations throughout the life cycle of the project. Website development. Our expert team of website developers and digital strategists use cutting-edge technology and best practices to create custom sites that increase user engagement. We understand that every custom web development project is unique. We want to get to know your brand, understand your needs, and determine an appropriate timeline and project plan tailored to your business. Anwar. Founder, Anwar. Email, nokaisoft@gmail.com